We got to get, if people don't know, we got next block. Let's get a picture of the new Zuck.
We have to.
We need a side-by-side comparison. All right. So let's tie all of this together, not Zuck's hair, jobs and markets in a nice little bow, and welcome in our friend Stephen Wieting. He is chief investment strategist, chief economist at Citi Wealth. And I'm just based on our conversation before the show, Stephen, okay. I'm guessing you would make it unanimous. 5 of 5, raise your hand. Jobs number didn't mean anything.
No, meaningless. I mean,
well, thanks for coming.
Well, we'll talk about market shortly. Mm-hmm. But just think about this. 512,000 people said that they couldn't work because of hurricane effects, these sorts of weather-related displacements. So how could hiring be usual in the month? That number is tenfold what it was in September. It's, nearly tenfold what it's been. There's a picture, in Octobers of years past. So every time we've seen this, the following month you get a correction upwards. And, maybe you could put both months together, but in reality, we can't measure the economy that well in periods.
Okay,
like
so then how many months would Stephen, I'm just going to ask everybody to refer to themselves in the third person tonight. How many months would Stephen Wieting and your team at Citi Wealth, how many months would you need to have confirmation of any kind of jobs trend?
4 months.
3 to 4.
3 to 4.
A quarter's worth of data.
Is something. But I mean, like the big picture, we went from the rebound from the pandemic, to under 200,000 per month. We were doing 6 million, then 3 million, then under 2 million. This is a slowing gain for the labor market and an accelerating gain for corporate profits. I mean, last year was lousy for most companies, negative 7% for EPS outside of Mag 7. And that's why we're gaining now.
You sound bullish.
We are. Look, this has been a big couple of years. We're overweight global equities. We're overweight the U.S. by about 6%, underweight the rest of the world by about 1.5%. And how far that will go, U.S. equities have outperformed the world by 15%. That's not that big a thing, but it's been 15 years of it, right? So the potential for us with non-U.S. stocks at 13 times earnings, we're at 22. We've got higher expectations.
Yeah, I think and Tim's the international expert, but I think this is a fantastic point you're making in that it's hard not to be bullish on America. I've been over in Europe covering their energy story. They pay 3 to 5 times what we pay, even the Nord Stream pipeline, regulation over there. The entire German DAX, their Dow Jones, is worth less than NVIDIA. So it's hard not, and China's, we'll talk later in the show about China. I wonder just how much the rest of the world's capital is saying, you know what, I've got to go to the United States.
Yeah, but that's, again, been 15 years of this. 3 American companies worth the entirety of Asia or the entirety of Europe. And our gains in market cap have been growing faster than EPS has gone up. We are outperforming on earnings. Our valuation's outperforming even more. So that's something in the event that if we were to go down the route of continued Fed easing, I think that's going to depend on the outcome of the election, Congress, what exactly we do after next week. But if we were to go down and be able to ease, the dollar comes off, we can see what happens. And it can be a period of some outperformance.
Well, I'm getting excited to listen to you because you're not saying something that I think maybe you're saying, which is that you're pretty bullish on corporate profits turning around. So we've got some inflection. We didn't have it. We now have an environment which there are not necessarily labor headwinds. It's slower growth, but it's still growth. And that you combine with the earnings power, it sounds to me like we should stay long this market.
Well, think about last quarter. We're not done with this quarter. Tech was the 3rd fastest growing earnings sector. Again, we had 3 that were above 20. We had 9 out of 11 sectors start to grow earnings again. And we have records for the next 2 years in our estimates.
Let me ask you about productivity. Was that where it comes from? Where does this earnings growth?
Absolutely. Again, we had productivity growth is strengthening. Again, it won't go on forever. But what happened in the pandemic, we, again, recovered very sharply in services-related hiring, which is not mechanized, it's not automated, it's very headcount sensitive. A typical large restaurant has more people working for it than a big warehouse or even a manufacturing company. So by 2022, when the Fed was tightening, saying the labor market's incredibly strong, that was when we were getting the pandemic services recovery. Productivity was sinking, and a lot of negative effects from Fed tightening were actually hidden beneath the surface into 2023.